The latest dot plot highlighting the growing division among FOMC members, with one member seeing the Fed hiking rates this year, another, who we can probably guess, seeing cuts of 1.25% over the next two meetings. Joining me now, Mohammed El-Erian, Queen's College, Cambridge president. It's so good to have you here with us in the studio, Mohammed. And so I noticed you retweet a comment from Jim Bianco, another longtime Fed watcher and investor. And he basically said this meeting was a mess of this latest FOMC meeting in terms of the dispersion, not just of Fed rate cut forecasts, but of the economic forecasts as well. Was it a mess?
And others have called it confusing. So there were two things. On the surface, we got exactly what we expected. We got a 25 basis points cut. We got a signal of 2 more cuts later this year. But once you go beyond that, it's really confused. The economic projections suggest something else: higher inflation, higher growth, and that is not consistent with cuts. In fact, according to the projections, we're going to have 7 straight years where the Fed has missed its inflation target. Then go to what you just talked about, the interest rate picture. If you look over time, it's a dispersion, meaning the difference between the people up here and the people down here is so large that there's no forward guidance. So yes, we got a nice outcome with only one person dissenting, but if you go beyond that, as Jim rightly said, it's a mess.
So, but all of that said, do you think they arrived at the right conclusion for the action that they did, which was the quarter-point cut?
I absolutely do. In fact, I think a quarter-point cut was warranted in July. So I'm glad that they're starting the cutting cycle. I'm also glad that they are putting the emphasis on the employment side of the mandate. They are facing this very difficult situation, as we heard Gary say, where the economy is going away from them, both on the inflation side and the employment side. So they are deep in the world of second best, and they have to decide which of the risk is larger, and I think the employment risk is larger. So I like what they've produced. I just hate the fact that we don't get clarity and we don't get an anchor from the central bank. We need some anchor in this economy, because otherwise it's going to get really complicated going forward.
What does that anchor need to look like? When you say anchor, what do you mean exactly? And what should they be changing?
So in the past, the central bank has always given us a vision of the future, where things were going. This central bank, after its big policy mistake in 2021, where it called inflation transitory, and as I said, we're going to end up at a minimum with 7 years above target, has become highly data dependent. So it's looking backwards. And as it looks backward, it doesn't give guidance to the marketplace, to businesses. And the problem with not having guidance from a central policymaker is that uncertainty goes up, and uncertainty discourages business from investing and could also discourage households from spending.
In their defense, isn't it a really difficult time to give that guidance? I mean, you know, you're in the economics profession. I've talked to so many economists over the past couple of years who have a new sort of source of humility, because it's been very, very challenging to forecast what the economy is going to do. That said, of course, the Fed's supposed to be the best at this, right? They're supposed to know. So, but how can they possibly be forecasting in this kind of environment?
So we need them and others to have a transparent discussion on 2 things that really matter for all of us. One is, what should we expect for productivity? Will AI, life sciences, robotics, where we're seeing incredible innovation, will we get the diffusion through the economy that allows a significant increase in productivity? I believe so, okay, but we need to hear. And then the second thing, you heard that, the first thing wasn't even mentioned. Yes. The second thing, and we heard that in the press conference, is what's really happening in the labor market? Is it a supply issue or is it a demand issue?
Or both.
Or both. And how much of it is both? And how much it would last? That's really important. Chair Powell started saying it's this, and then said, well, no, it's a bit of this. They need clarity on this. And I think that clarity is possible on this. But again, they're shying away. Now, I understand that on the enormous political attack, I understand that Chair Powell is coming to the end of his term. But if you don't have a policy anchor to this economy, the risk of volatility goes up, economic volatility, not market volatility. The market is happy to bet on the corporate side. The market is this very strange world where it says, I know the sovereign is messy. We have tariffs, we have central bank independence, we have high fiscal deficits, I know that's messy, but I'm happy to bet on the corporate side.
But is the Fed the real source of volatility on the corporate side, or is fiscal really, our tariffs, our policies that, sort of are very volatile themselves? Is that the real source of volatility for corporations?
So that's why we need the Fed even more, because on the administration side, they are attempting a major rewiring of the domestic economy and a major rewiring of the global economy. You need some anchor. I remember, I'm old enough to remember the early 80s when President Reagan came in and he undertook a major rewiring of the domestic economy. The Fed was there providing a very clear anchor as to where it was going. And you cannot have a situation where you have major uncertainty on the two greatest influences on the economy.
Now, you, a couple of months ago, made some waves by suggesting that Jay Powell should step down already.
On your show.
As head of the central bank. Exactly. We talked about it. You faced a lot of skepticism on that from various quarters. And now you're saying, even if he doesn't step down, there are certain changes he should be making now to put the Fed on better footing going into the leadership change. What changes should he be making?
So let's start with our discussion of July. At the time, I was worried that because of the tensions between the president and the chair, if Chair Powell didn't step down, the attacks on the Fed would multiply. And that is exactly what happened. And it is continuing to happen. And the reason why is very simple. The administration is looking for cause, a reason to fire Chair Powell. When you look at an institution, take a microscope to it, you will find something. And they are finding one thing after the other. And in the process, the objective of the administration is changing. Who would have thought in July that they would have their eye on the reappointment of the regional Fed presidents in February? But suddenly that's there. So what I was afraid of is happening. The other thing that's happening is now there's a massive understanding about something you and I have talked about before, is you need fundamental reforms to the Fed. You need greater accountability, you need greater transparency, and you need less groupthink. And we have really good examples of other central banks that have addressed these issues. The Bank of England, for example, has external members on the equivalent of the FOMC. And those external members guard against groupthink, because if you're within the Fed, the incentive to be in the herd and not question it.
Well, but at the same time, on the one hand, you have this huge dispersion in the dots, which we called sort of a messy meeting. On the other hand, you don't want groupthink. I mean, don't the dots illustrate that there isn't groupthink?
And that's the problem. People are saying, so let me get this right. We have dispersions and where we're going. We have inflation going up. We have growth going up. We have employment, according to the Fed, only peaking at 4.5% and coming back down, and yet we're cutting. You would have expected two-sided dissents. That's what you get at the Bank of England. We didn't. We got one dissent. In fact, one of the big surprises is we only got one dissent.
Right.
And I think it's important to understand what happens in a group dynamic is that you tend to iterate and converge towards a view. And that, unfortunately, undermines the sort of cognitive diversity you need at turning points. There is a reason why the Fed has been consistently late, because they don't have the amount of cognitive diversity that they need to say, what if? I thought Stephen Moran was really interesting when he said, I'm not the smartest in the room, but I'm willing to ask the questions that other people aren't willing to ask. And I think that the Fed needs more of that.
But a voice like Myron, or whoever ends up being the Trump-appointed nominee to replace Powell, how do you separate an earnest intellectual discussion from someone who is effectively a plant of the administration?
So look at the Bank of England. All the external appointees are people that have come either from economics or finance, that have come from outside the government, outside the central bank. It's understood they're going to serve 1 or 2 terms and go back to the outside. So they are technocrats. And then they join other people that have different backgrounds. And that's the whole point of cognitive diversity, is you bring different viewpoints And it's really important. My career has shown that when you have different viewpoints in the room and you can talk about it in a safe area, you get better outcomes.
All right, well, we'll see if that happens. If there's any chance of that happening, especially before the turnover in the Fed chair. Mohammed, thanks so much for coming in.
Thanks for having me.
Really appreciate it.
Your sense of what Jerome Powell said yesterday on the economy?
Yeah, look, I think yesterday was a very interesting day. The chair admitted he's got a problem. He's in a conundrum. He's got a two-factor model. Factor number one is stable prices, which is basically a goal of 2% inflation. He's not achieving that. He's higher than 2% inflation. On the other hand, he's got a factor two, which is full employment. He sees very clearly that the employment market is softening. The data has come in very soft. You know, we're seeing 50,000, 25,000 new jobs created each month. So the chairman's sitting there going, look, I'm trying to balance these two parts of the equation. Which one matters to me more today? Knowing that if I fix one, I may affect the other. And he sort of admitted that yesterday. So he pivoted yesterday and said, I'm going to deal with the employment problem in the United States. We're going to cut interest rates by 25 basis points. We're going to sort of dip our toe in the water. He actually called it a risk management exercise.
It's clever. That's what stuck that in there. Yeah.
Risk management exercise. We're going to cut 25 basis points, and we're going to see if we can help job growth in this country, knowing that cutting interest rates is stimulative to the inflationary side of the economy. So he's in there admitting he's got this problem, he's got this conundrum. You know, his committee as a whole, you know, he's got a committee that votes as a whole, really had a pretty interesting divergence of where they think interest rates are going and where they are. You know, you literally had one person on the committee that, even though it seems like they voted for this cut, in their projection of where they think interest rates would be, they did not have this cut in their projection. Then you had 6 more that said, we don't need any more cuts for the rest of the year. Then you had 9 that said, we need 2 cuts for the rest of the year. So even just looking out between now and year end, the chair's got to balance a committee that understands they're trying to deal with this two-factor model. You know, it does look like we have started a rate cutting path, but it seems like it's going to be a slow, methodical path, and it's not a guaranteed path. So, you know, if you look at where the dots plot out to the year end, it's about 3.6%, which is about 2 2/3 of a cut. So it looks like one more is baked in for sure, and maybe 2.
Every time the Fed chair mentioned the labor market, I'm like, wow, I mean, the jobs market's going to stink. It's going to get worse. But does that reinforce the point we've heard from President Trump that this is too late, Jay?
You know, I don't know if it's too late, Jay. The job market has clearly been softening over the last few months. On the other hand, the inflation numbers have not come down as fast as the chair would want. Now they've come down, but they're still stuck, core's still stuck around 3%, 2.9%, and his target is to get it to 2%. So look, you can criticize any part of this whole equation you want. You can criticize that the chair is late because the job market has gotten soft. You could criticize because he's being too aggressive because inflation's too high. Like I said, it's a two-factor model he's trying to balance out.
You will not hear Powell say this, but did he bend to pressure from the administration?
I don't think so. At the end of the day, I don't think he bent. In fact, if you look at the committee, there was one dissenting vote. The entire committee.
Stephen Myron.
Yeah.
Right, yeah. New guy.
Yeah, the new guy. The entire committee voted for this cut, and there was one dissenter. It's funny, in the meeting prior to this, there were more dissenters than there were in this meeting. So it actually looks like the chair has brought the committee together, is more cohesive. They've got a methodical plan that they're on right now, this slow but steady potential cutting cycle.
How worried are you that we do see a deeper economic downturn at the same time the Fed is cutting rates?
There's always the potential of a deep economic downturn. That's part of the economy. We have events that we don't see coming, and we always get caught off guard because we don't see them coming. So, we have these quote-unquote black swan events. If they were white swans, we'd know they were coming. Yeah. So look, we're always worried about events like that, and usually there's some cause that happens, some exogenous event that happens. As I sit here today, I don't see anything. But I would have given that same answer a month before a couple major financial crises, that the world looks good today, I don't see anything. And after these events happen, they look pretty obvious. To me right now, we're in an environment where the equity market's at record highs, credit spreads are all-time tights. Look, the dollar's weakening pretty considerably, but nothing looks too out of line right now.
You're a plugged-in guy. Do you think we get a Fed chair announcement before year end, and who do you think gets this job?
Oh, I have no idea when it gets announced. I really don't.
Is there someone you think that would be best suited to get this job?
No, look, I think the president has a good list of candidates. There's some people that are very, very qualified, very highly qualified, and I think we'd be lucky to have them.
Of course, we were talking about a little bit about tech off camera. This is an interesting time to tech. We saw the NVIDIA Intel news. Is this a good thing to see these tie-ups like this?
Well, there's some good in this, always. Look, the United States, as we know, has to become a chip manufacturer. We cannot be dependent on the rest of the world for chips. Look, we came out of COVID understanding the supply chain better than we ever did before. We understood that without chips being imported to the United States, our economy, our manufacturing economy, shut down. You literally could not buy most of the things that we want in this country. Even simple things as toasters today somehow have to have chips.
Well, you got to connect to your phone, Gary. I need to know when my toast is done.
I guess you have to hit your phone in bed to put the toast down in the morning.
Yes.
So you can do that. So look, we now are in an economy where everything we buy has a chip in it. We can't be beholden to the rest of the world. So to the extent that the federal government is getting involved in encouraging chip manufacturing in the United States, and this started in the last administration with the CHIPS Act, and we continue to press on this independence of vital necessity goods in this country, I do think is a good thing.
Do you view it as the administration picking winners and losers?
I hope the administration's not picking winners and losers. It's not their job to pick winners and losers. What it is the federal government's job is to protect the citizens, protect our safety, protect our well-being, and we know that chips are a vital part of protecting our country. You know, simple missiles today have 300 plus chips in them. So to be able to defend ourselves, to be able to build military equipment, we need to be in the chip manufacturing business here. So that I do applaud, that we understand the risk of not having chip manufacturing in the United States.
IBM investing just billions of dollars in AI and its own infrastructure. Where do you think we are in the AI CapEx build-out?
You know, look, the AI CapEx build is pretty transparent. There's an enormous amount of money being spent in data centers. These data centers will come on sort of over the next 3 to 4 to 5 years. You will continue to see more and more use of AI. What's going on right now is, you know, people are using AI, but they're using sort of independent software, independent programs to solve a specific AI problem.
Like an agent.
Yeah, like an agent. So
do my payroll.
Oh, do my payroll. Handle my HR. Read my documents. Help me with my tax return. Help me with my tax returns. Where I believe this is going, where IBM believes this is going to an enterprise-wide solution, where all of these AI programs, these AI facilities will work together. They'll be more coherently, more cohesively related, and they'll have a big infrastructure behind that. And look, that's going to lead us into a really interesting world as people get their data and databases in a more coherent place, and that's what it takes to make AI work. It's going to lead us into a quantum revolution. We think by the end of this decade, we're going to have quantum, be a major part of this equation.
Where can I get one of those toasters? IBM doesn't sell those, right?
No, they don't. But we probably wrote some of the software inside.
All right, well, that's true. Gary Cohn, good to see you. I'll see you at Davos, man.
I'll see you there.
Joining us now for a closer look at the delicate balance of risks the Fed is facing, we have Loretta Mester, senior scholar at Princeton University and former president and CEO of the Federal Reserve Bank of Cleveland. Loretta, it's great to see you. We were just talking to Kathy Jones about the dispersion of dots, and we also know, just because of sort of the drama in the days leading up to this Fed meeting, we know about the dispersion perhaps of personalities and views inside the Fed chamber has been sort of widening. How should investors be thinking about that and how they can reach consensus? Not today, they've reached it, but for the remainder of meetings this year.
Well, the first thing to point out is there's a reason for dispersion that's independent of the personalities in the room. And it really has to do with there's cross currents in the economy. And some of the things that we're seeing are due to reactions of firms to higher tariffs that are either in place already or coming. Some of it has to do with the labor market and the fact that the supply of labor is moving as well as the demand of labor. So there's a good reason with so many cross currents on the economy that you'd expect to see policymakers doing their job and really perhaps coming with different data, different views of the data different reconnaissance from their districts and maybe having a different opinion about what is the best policy to get back to full employment, maximum employment, and price stability. And so that's showing up here. And that's not a problem because that's the type of dispersion in views that one might expect given the uncertainty about where the outlook is going. They did reach more or less consensus. There was only one dissent. I know some people were thinking that we might see more this time. So, it looks like they had a good discussion around the table about the economics, the outlook, and really this is a risk management process here, right? We know the downside risks to the employment part of the mandate have gone up with the data that shows that employment is weakened. We're not necessarily saying the employment picture is bleak because supply and demand are really still in balance, although, it's like I call it an uneasy balance because demand could begin to pull back more than so far, but the unemployment rate remains low. So again, the inflation numbers, again, the committee has said, many members, that they think they're going to look through that in terms of it's a one of, but others are more cautious, and you can see that in their projections. As I think someone on your panel before, the dots really speak to the different narratives that could really explain this economy. Some are saying that we do have an inflation issue independently even of the tariffs because services, core services, X, housing is not moving down on a path back to 2%. It seems to be quite sticky. And I think you see that in the dots with people reluctant to do more cutting. And others are probably putting more weight on the employment picture and looking at that picture and saying downside risks are starting to manifest themselves, and so they should take out more insurance and therefore cut more. So I don't see this as a problem or even anything that's really surprising, that given the environment we're in, that you'd see this kind of dispersion. And the chair did a great job, I think, in bringing the parties to the table and getting a consensus. And we'll hear more in the press conference about what that meeting, how they determined where they went to and what kind of balance of risk they're looking at.
Loretta, you mentioned personalities there, and there's a lot going on there, Loretta, in terms of the personalities. You got a lot of drama with Lisa Cook and Stephen Myron, and I'm just wondering, Loretta, how you're thinking through all that. If you were still at the Fed, how you would be navigating all that, Loretta, these personnel issues.
Look, I don't know Steve Myron, but I know the other people around that table. And I can tell you that all that is left outside the room. When you go into the room, you're there to do your job, which is analyze the economy, bring your best judgment to bear, look at the models, hear what the staff says, hear what your colleagues around the table are seeing in their districts and how they're interpreting the data and the economic developments that we've seen since last meeting, and then coming up with a path forward into what's going to get us back to price stability and maximum employment. So all of that stuff may be, thought about when you're out of that room. But once you're in that room, you have a job to do. And the people I know at the Fed take it very seriously. They're very dedicated to the mission of the Fed and hitting the congressionally mandated goals. And that's what they do in that room.
So in that room, as they make those earnest arguments, I'm going to ask you a similar question, what I asked an economist earlier, which is, do you think there is a valid argument for a half-point cut to have been made today, as Myron presumably made?
Well, I don't know what Myron said in the meeting, so set that aside. But yeah, I think there could be a credible case. Certainly not what I would support, but the case would be, we saw the weakening, starting at the earlier meeting, the July meeting. There's some who wanted to cut at that meeting. So let's go back to the data came in and confirmed the weakness in the labor market. So let's make up for that, perhaps a bit late start and do 2 now, and perhaps then do a couple more this year. So the data are coming in. It's really how you're balancing the risks. Some are going to see the labor market demand side of the labor market justifying a cut, but others could read the labor market as saying, well, we shouldn't expect to see the 150,000 per month job pace that we used to see because the supply of labor is also moving down. And so, estimates of the break-even rate, i.e. the rate of job growth that's going to keep the unemployment rate constant is now, about 50,000 to 60,000 per month, not the 100 to 150 that we used to have. And so part of the calculus here is this really a strong weakening in the labor market, that could pick up and therefore we need more insurance cuts, or is this really the labor market stabilizing at a lower level of job growth? And we don't know that yet. We need to see more as the economy evolves. And so, I think I'm hoping that the chair doesn't necessarily lean in one way or the other. I think this is a case where it's an evolving economy. You have to analyze going forward. And, they're poised, if they need to cut more because the labor market's deteriorating more than they expect, they're in a position to do it. And if inflation turns out to be continuing to be sticky, they need to keep policy somewhat restrictive. And I think the 25 basis point today still maintains some restrictiveness in policy, although they differ in how much they view that restrictiveness. Some would probably say, okay, 1, and now we're at neutral and do no more because inflation's still elevated. Others would say there's still room to cut and still be restrictive on policy. So again, that's another difference of opinion, and they'll have to see how the economy evolves to make their decisions at meeting by meeting going forward.
Loretta, on Myron being the only dissent, the rest of the Fed stuck together. Did that surprise you at all, Loretta? There were some who would assume maybe you'd actually see more than one dissent here.
I didn't know, obviously, but again, a 25 versus a 50 is not that different in terms of the impact on the economy. And I know that some wanted to cut last meeting and there were 2 dissents there, but again, their policies moving in the direction that they thought was appropriate, and that doesn't seem to warrant, a dissent in my view, because you got what you were asking for, which was reducing the degree of restrictiveness.
Ahead of the Senate Banking Committee's confirmation vote on Stephen Myron to be Federal Reserve Governor, you told your colleagues that if you're in favor of Federal Reserve independence, then you should vote no. Myron was confirmed by the full Senate last night. Today he's participating in the Fed's monetary policy meeting, but he has not resigned from his position at the White House. He's on a leave of absence. How could Myron threaten Federal Reserve independence?
So look, Myron is just there to be Donald Trump's sock puppet. And Myron himself was not willing to speak at all independently when he was in the hearing. And as you rightly point out, he hasn't even given up his job with Donald Trump. So he won't reveal any of his communications with the president, nothing. But understand what this means for the American people. When you undermine Fed independence like this, and the idea is that instead of having the president over here making political decisions, and the Fed over here, when it comes to things like interest rates, doing the best economic decisions they can based on the data, when you undermine that, then when the time comes that the Fed has to make some hard decisions, and sometimes they do, then at that moment, Fed can't do it, and that means costs go up for everybody in America. Everybody who's got a credit card or a payday loan or a mortgage or a car loan, and then ultimately that increase in the cost of credit, because no one can rely on the independence of the Fed, filters through to the cost of every single thing that Americans buy. Costs are already up in America right now. Inflation is already on the rise. Undermining the independence of the Fed pushes our economy in the wrong direction.
Myron's confirmation comes as President Trump is trying to fill the central bank with members who are in favor of lower interest rates. And the president tried to remove Fed Governor Lisa Cook. A appeals court rejected that last night, and the president is expected to appeal that to the Supreme Court. If the high court were to uphold the president's firing, is there a place for Congress to step in and amend the Federal Reserve Act to create a narrower definition of for cause for when a president would want to remove a member of the Fed?
So look, if the Supreme Court follows the law, then Lisa Cook will keep her job. If they don't follow the law, certainly Congress could change the law. The problem is that right now, the Republicans do whatever it is that Donald Trump wants. And if I can, Jennifer, let me just pick on one point in the way you described what happened here. It's not that Donald Trump wants people who will lower interest rates. He wants people who will do whatever he wants them to do. Right now, that is lower interest rates. Maybe that would be his answer forever. But the real point is not an economic policy point, it's a power point. Donald Trump wants to control everything. And when he is making his own political decisions, ultimately, that will undermine prices, it will undermine the efforts to keep inflation under control, and that will undermine the economic health of our country.
To your point, the Federal Reserve set to make a policy decision tomorrow, widely expected to lower its benchmark interest rate by 25 basis points. The central bank is grappling with sticky inflation. It's running about a full percentage above the Fed's 2% target. At the same time, the job market has weakened over the last 3 months. You said the Fed needs to make tough decisions, and this is one of those moments. What would you like to see the Fed do right now? Are you in favor of a rate cut?
So look, I've argued for 2 years now that I want the Fed to cut rates. I thought that inflation was well under control, headed in the right direction, and the Fed could bring down the interest rates. The problem now is that Donald Trump's chaos has so weakened the economy that we're watching the first signs of stagflation, and that is that inflation is tilting up and unemployment is tilting up simultaneously. The Fed, of course, only has one tool, and it uses it differently. If inflation is going up, it raises interest rates. If unemployment is going up, it lowers interest rates. And this is the box that Donald Trump has created. You know, I think there's something important to underline here, and that is the chairman of the Federal Reserve said last month that the Fed would have lowered interest rates last February if only Donald Trump had not created so much economic chaos. So the way I see this is one person right now is responsible for the high costs at the higher interest rates and for the increasing problems that we're seeing in the employment market. And that one person is Donald Trump.
But should we anticipate, do you think the rate cut is the right thing to do here, given what's going on the inflation front, given your concerns?
I think that Donald Trump and the chaos in this economy are backing the Fed into a box. I am really worried now about those unemployment numbers. I still want to see the Fed cut interest rates. But it would have been so much better to cut them when we had a strong economy and strong employment.
The president has said that he has narrowed down his pick for the next Federal Reserve chair to 3 candidates, including former Fed Governor Kevin Warsh, current Fed Governor Chris Waller, and the director of his National Economic Council, Kevin Hassett. If nominated, would you support any of those gentlemen?
Look, I'm going to ask the same tough questions. Are you really independent? Can you actually answer the question, did Donald Trump lose the 2020 election? Do you have enough independence to stand up for what you believe is right on economic policy? Or are you just going to be one more person who does whatever it is the great Donald Trump wants? And the reason that is so undermining is it's not whether or not Donald Trump is right or wrong. It's that we will have lost, under Donald Trump's efforts, all of the independence of the Fed, and that undercuts confidence. Confidence that, in fact, we will have a Fed that will be harsh on inflation. Confidence around the world that people say we can count on independent economic decisions from the United States of America. You lose that confidence, prices go up for everybody.
Switching gears, Senator, President Trump has said that he believes we should scale back quarterly earnings reports to twice a year because it would cut down costs and would allow management to focus on longer-term business objectives. SEC Chair Paul Atkins has said in a statement that he is going to prioritize this. What do you make of this? Does this hurt transparency for investors who are investing in publicly traded companies? And if the SEC were to pass this, would you step in to block it?
So yes, it undermines transparency. That is the whole point here. Investors do not need to see less information about the companies that they are investing in. After all, those companies are using investors' money. But this is the standard Donald Trump trick. And that is, if you don't like the numbers, then try to get them out of sight. And that's what he's trying to do. What did he do when he didn't like the employment numbers? He fired the head of the Bureau of Labor Statistics. Evidently, he did not understand that would not stop the reporting of labor numbers, nor did that person have control over those numbers. But it's the same kind of thing here. Donald Trump does not want real numbers reported in any of the economic areas because he knows he's in trouble on the economy. And remember, this is a president who ran promising to lower costs on day one, and that is entirely turned upside down. Costs are up, 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 and this economy is weakening day by day with Trump at the helm.
Really quick, Senator, before I let you go, Paramount Skydance now making a bid for Warner Brothers. You're worried about a concentration of power there?
Yeah, just too much, okay? Too much in the same industry, and understand who really gets hurt here. It's the other competitors, but it's also every customer who's only got one place to go, because what have we learned in every industry? When you end up with more concentration, prices go up, that hurts the customer. Customer service goes down, innovation goes down, and other businesses end up withering often and dying. Look, I believe in markets, but for markets to produce their magic, there's got to be competition, not concentration.
Senator, thank you so much for your insight, especially at this critical time. So appreciate it.
Thank you for having me. I appreciate it.
Hope to have you back soon.
You bet.
Here with more on the Fed's rate decision now, we've got Gregory Daco, EY Chief Economist, and Merra Pandit, Global Market Strategist at J.P. Morgan Asset Management. Welcome to you both. Greg, as the resident economist on the panel, my friend, we will start with you. Just big picture, your reaction to the Fed decision, Greg, what do you make of it? Was it the right decision?
Well, I think it was definitely the right decision. I've been arguing for a while now that the economy is showing signs of softening. It's not falling off a cliff, but we are seeing the labor market show signs of softening. Mm-hmm. We are seeing consumers being more judicious, even though there are mixed signals in terms of the labor market, in terms of how people are spending, in terms of inflation. There is increased evidence that these tariffs, these immigration restrictions, and the policy uncertainty are restricting private sector activity. And I think the Fed is right to proceed with a risk management rate cut, acknowledging this slowdown in the labor market, acknowledging as well that inflation is still above its 2% mandate, and acknowledging that risks to the labor market are tilted to the downside. But I think one very interesting dimension here is that we're seeing this growing split in the dot plot of median rate hike expectations. You have one rate expectation which is below 3% for the end of the year. That's likely Stephen Miran's estimate. But most of the view is still that we're going to see 2 to 3 rate cuts over the course of 2025, but less easing, interestingly enough, in 2026.
So how does this comport with what we were expecting in terms of what the market was expecting? And we are seeing a little bit of a lift to stocks, for example, but not a huge move upward. That could change during the press conference. But what do you make of the dots and the implications?
25 basis points was largely expected for this meeting. Look, if the Fed had gone 50, I think the market would have been a little bit more prepared for it given what happened last year. But I would say overall, we have 3 conversations in any of these cycles, whether it's hiking or cutting. It is first the direction of travel. We know cutting is the direction we're going in. The second is around the pace. And then the third is around the endpoint. Where do we stop? Where is the terminal rate? And right now we're in that pacing conversation. So it is interesting to see that the Fed does see a little bit more cutting this year. I think that, again, that is broadly expected. But next year is such a big question mark. And it seems like what the Fed has phased out here is We want to be attentive to the risks in the labor market. When you see the massive slowdown in labor market momentum that we have seen over the last couple of months, that's an important consideration. But as we head into next year, remember that consumers will get some pretty big refunds when it comes to taxes. That will likely lift consumption and therefore growth. Corporations will also get some tax corporate sweeteners, so to speak, not necessarily cuts, but those provisions may lift profitability and lift CapEx. So we could be in a situation next year where growth has sped up, where inflation has either sped up or stayed elevated. We actually don't see it peaking until June of next year. And so that would imply that all of a sudden the Fed is go, 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 and then stop a little bit into next year. And I think that's reflected in the dots for next year.
Greg, can I get your take on the broader economy, Greg? It's noteworthy to me how I have very smart economists on the show, and I have such a range of opinions about it. I mean, there are some who flag the concerns, and you highlighted some. There are others, Greg, though, I have on who are much more confident. And I guess, if I was to sum it up, they'll talk, Greg, tax cuts and rate cuts, and they'll talk deregulation and the AI boom, and they'll say those are all tailwinds. Agree with that? Disagree with that? Give me your take.
Well, I think the one thing I'll agree on is the fact that there is very little confidence in forecasts right now. Because there are so many headwinds and tailwinds that are affecting the economy, the signals are conflicting. Whether you look at retail sales in nominal terms over the course of the past month, you would argue for a strong economy, a strong consumer spending. You peel back the inflation contribution to that, and you see that volumes for furniture, for building equipment, for groceries are falling back. So we're seeing essentially this consumer that's supporting this tension where prices are rising, labor conditions are softening. They're not falling off a cliff, but they're softening, and businesses are caught in a pinch because they're hesitant between passing on these higher costs to a consumer that is increasingly sensitive, or holding on to them, but seeing essentially a compression in margins. And that's really the trade-off that a lot of businesses are facing. This is an uncomfortable environment. It's a delicate balance. I hear a lot of people talk about the no hire, no fire labor market. That is not a sustainable balance. At one point, you're either going to see more employment or less or more firings. It's not going to be this comfortable balance when it comes to this labor market.
Merra, I want to bring you here as well. I mean, I do want to talk politics here, Merra, in the sense that, listen, there's people who are voting here who are making lists as maybe the next Fed chair. They're in the running. How, if at all, Merra, do you think that is impacting decision making?
Where I will defend Fed independence here is let's forget about everything that's happened this year and think about the dot plot and the summary of economic projections that we saw in December of last year. And in December of last year, the Fed was looking for 2 potential rate cuts in 2025. And what we are likely to see is 2 rate cuts or potentially 3 in 2025. So it's really in line with what they were saying months ago, in that there was an anticipation that the economy would soften relative to the last few years. Now, tariffs certainly threw them for a loop, and they have acknowledged that, look, if it weren't for tariffs and if it weren't for potential higher inflation coming along the way, that they would already be cutting. And typically, the Fed actually does tend to cut before they get all the way down to their inflation target. With 3 meetings and now 2 meetings left in the year, it's not unrealistic and unreasonable what they have chosen to do, especially when it's supported by the weaker labor market data that we've seen. So it is a committee. You do see with the dissents, there could have been a lot more dissents than we actually ended up seeing. So that consensus building still does appear to be at play underneath the surface.
With one exception.
Sure.
Right. So I want to talk about the exception a little bit. Stephen Myron saying we should have cut a half point. Is there a legitimate argument to be made for having cut a half point today? Or does this emphasize that he is exclusively a mouthpiece of this administration that very clearly wants a cut for its own purposes?
I mean, I think you've heard me argue the rationale that we're going to see tariffs affect inflation, affect prices, but it's likely to be a one-time hit because the labor market is softer than it was back in 21, 22, where you had this wage inflation spiral. You're not going to get that in this environment. Wage growth is actually decelerating. employers are not looking to raise wages, they're looking to cut costs and cut employment. So you're not necessarily seeing that potential for a second round effect on the wage front. So I think the pass-through from tariffs is likely to be a one-time shock. We still have some disinflationary currents in the housing segment, for instance. So there is room for the Fed to be easing, to be buffering this negative shock to the labor market. I would have argued that you can actually ease monetary policy and bring it back closer to neutral over the near future. So I wouldn't have been opposed to a 50 basis point rate cut. What I found surprising is that Governor Waller and Governor Bauman did not dissent. They were in favor of this 25 basis point risk management rate cut. This was in the statement. Essentially, in light of the growing downside risk to the labor market, we're going to be cutting 25 basis points, and we're going to keep adjusting monetary policy as needed, as the data shows and as the data reveals how strong or how weak the economy is. And that's, I think, where the market pricing is perhaps getting a little bit ahead of itself. We're not necessarily going to be in an environment where the Fed's going to be cutting at every single meeting, regardless of the economy. A lot of attention will be paid to inflation and to the next payroll report.